Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss what's driving the direction of the market. And Phil, while we hit all-time highs last week, sold off towards the end, it wasn't COVID that was driving the story. So what are you taking a look at? What's driving the markets here?
Yeah, I mean, you would think with all the discussion about the Delta variant that the markets would be having a lot more trouble than hitting all-time highs midweek. But what really seemed to put a cooler on the market last week was a couple of the tech companies with earnings that disappointed, at least in the commentary that came with the earnings. So really good earnings numbers, good revenue. But they're talking about headwinds coming in for them to continue the sort of work from home growth story with everybody not working from home theoretically in the next 12 months.
And Phil, if we take a look at COVID cases here, while we're not seeing an increase in death or hospitalization like we saw in the initial outset of the pandemic, it's interesting to see how employers are thinking about deploying vaccination mandatory.
Yeah, in reality, I think one of the reasons the markets aren't that scared about COVID is, to your point, there's not a huge pickup in hospitalizations among vaccinated states. There's not a huge pickup in death rates nationally. So it seems like we're learning to deal with COVID better. The amount of vaccinations we've got are helping to keep most of the population healthy. And so to your point, really the trick now is to get the vaccinations out to those people that haven't had them yet. And you can see, if you look at the states where the rate of hospitalizations or the rate of COVID per person is picking up and looking like a hotspot, it's really localized, and it's localized in those states that have low vaccination rates. So I think that's one reason why people realize this is not widespread like it has been in the past, but also people are looking at the fact that Delta variant was widespread in Britain and causing a huge uptick in cases there just a few weeks ago. And all of a sudden, the cases have turned around. So Britain's got a pretty high rate of vaccination. And it just looked like maybe Delta variant sort of ran up against enough inoculated people and people that had COVID before that were somewhat immune to it. And people dealt with it better. They didn't end up in hospitals. And so that, combined with the fact that the same kind of thing happened in India, where it wasn't due to the vaccinations, but COVID in India seems to have subsided as well, that people think maybe in the US we're a couple of weeks behind the UK, and we will see COVID just naturally peter out because of the amount of vaccination and the people that have already had COVID in the economy.
Yeah, well, let's hope so as school starts and we get all back to the offices and so forth. That's really going to be the key is, in the Northern Hemisphere, as it starts to get colder and we go into the fall and into the winter, we really want to see that immunity and the vaccinations pay off there. Another area that the markets are focused on, of course, are interest rates and inflation. And while interest rates have come down, inflation expectations are starting to climb. Why do you think that's happening?
Yeah, I mean, it's pretty interesting, isn't it? When we had the election and we heard all about the extra stimulus checks and the huge infrastructure bill and massive fiscal stimulus, the interest rates went up by about 0.5% on the 10-year yield. They've yet come down about 0.5%. So now we're sitting at 1.25% on the 10-year, which is well below inflation. So to your point, the bond yield on 10-year treasuries is below inflation. You could buy TIPS, which actually pay interest based on inflation, and they're at a discount. So you can reverse engineer what the market thinks inflation is going to be because of the difference between the two of them. And it's started to pick up. But I guess to your point, the pickup hasn't got the expected inflation to ridiculous levels. It's sort of 2.5% market wide. And the reason that it hasn't gone higher is because the inflation that we've seen, the sort of 5+% inflation print in the headline index, is because of things like airline prices going up, hotel prices going up from depressed levels, and car prices and car rentals going up, the price of some commodities like lumber, making it expensive to build houses. But that's a short-term sort of supply stress on the economy, which is expected to loosen back out, and those prices are expected to come down. So the Fed keeps saying they think inflation's transient, and that's why, because all of the prices that are going up now are either catching up or sort of inflated artificially just because of everybody not being able to work, to your point, because of COVID.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.